Hi guys, I'm Adam and today I'll be going over the intuition behind tariff and quota. So as you can see in this diagram, it actually composes both of a free trade scenario, a tariff scenario, and also a quota scenario. So I'll begin by talking about the free trade scenario. Under the free trade scenario, we have the world price, which is showcased by this dashed pink line over here, S1, and the price is $60 per barrel at the free trade situation. So let's first look at the welfare under the free trade scenario. So we first calculate the consumer surplus, which is the area below the demand curve and above the supply curve, which is essentially A plus B plus C plus D plus E. And the producer surplus is essentially the area below the world price, or the price in this case, and above the supply curve, which is F. So if you are not really familiar with consumer surplus and producer surplus and welfare analysis, you can check out my video that I posted before. So in this situation, the total welfare is essentially A plus B plus C plus D plus E plus F is consumer surplus plus producer surplus. So we have covered all of that. And then we would like to move on to talk about the tariff. So tariff is basically a per unit tax imposed by the government on foreign imports. So what it will do is essentially it will actually increase the cost of production for foreign firms by shifting up the world supply curve up to S3 in this case. So you can actually extend this supply curve if you want, but it's not necessary because it's not going to do us any favor in this analysis. You can just leave it like that. So in this case, you can see that in the free trade scenario, the domestic producers is originally producing at the level of 9.6 million barrels of oil per day. That is because the original price is at $60, and the originally domestic supply, that is a domestic supplier, is this curve. So the intersection is essentially the quantity that the domestic producer will produce. But after this tariff imposed on those foreign producers, the market price within that country will be increased to $100 per barrel. So because the market price increase, the domestic producers are more incentivized to produce more in this case. So what they will do is they will expand their output because the new intersection between the price and the supply curve of their supply curve is essentially, it's not really well drawn. It's supposed to be 10.9. So it's increased from 9.6 to 10.9. And so that's basically the increase of quantity of domestic suppliers. So before the imposition of the tariff, the total quantity supplied in the market is 17.5 million barrels of oil per day. So because 9.6 is covered by the domestic suppliers, which means that the rest of the quantity is covered by the foreign suppliers. So they are originally actually supplying 7.9 million barrels, which is the difference between the total supply and domestic supply. And after this tariff, because of increase of price, increase of cost of production, the foreign producers are less incentivized to produce. So they cut their production from the original 7.9 million barrels to 4.5 million barrels. So how do we get the 4.5 million barrels? So we first trace this quantity to the demand curve. So how much demand are there in the market? It's 15.4 million. So because 10.9 is actually covered by the domestic producers, so the rest 4.5 million barrels per day is actually on the foreign supply. So the foreign supply is reduced from 7.9 to 4.5. And let's analyze the welfare within this case. So after this imposition of tariff, there's actually 2 deadweight loss. Why? Because first of all, the consumers gets to consume less and the producer gets to produce less. That quantity E is lost because you can either look at it from producer's perspective or consumer's perspective. So we usually look at that at the consumer's perspective, meaning that the consumer actually gets to consume less. So that they're like total, because it's like below the demand curve, so we usually view it as a loss of consumer surplus. In this case, it's loss of consumer surplus of E. So in this case, E is actually a deadweight loss because it's not recovered by any of the parties. Notice that another deadweight loss is actually area C. Why? Is because area C is originally produced by the foreign producers who is more efficient at producing things at lower price, but now it gets substituted by the domestic producers who is actually less efficient. It requires a higher price to produce things. So the difference between these quantities and also the area below this supply curve above the price level, and also so these 3 lines actually gives us the triangle over here, which is the welfare loss by the society. So the C and E are both deadweight losses, as outlined in here in the chart. It's negative C minus E. So that's basically the deadweight loss. You might be wondering why D wasn't included. Well, D, the area D, the whole rectangle over here is actually the revenue earned by the government. So it's actually get transferred from the consumers who is paying a higher price actually to the government. Or you may say, like, if you're comparing it with quota, is actually transferring from the producers to the government. But as you may see that these two are not both incorrect, because there is a thing called tax incidence, meaning that any imposition of tax will actually mean a proportion of tax bear by the consumers and producers. So both the producers and consumers will bear the tax burden. The extent to which they will bear the tax will depend on the elasticity of demand and elasticity of supply, which will be covered in later videos. So apart from that, that chart is pretty clear. The consumer surplus is A. It's below the demand curve and above the supply curve. The new producer surplus is B plus F. Notice that the producer surplus here, I'm talking about the domestic producers. We are not talking about foreign producers. So the new producer surplus will be this area. It will be below the price and above the supply curve. So it's B plus F. And the quota that doesn't really, the tariff actually gives the government D amounts of revenue. So that's basically the tariff.